Turn to Douglas Holtz-Eakin. He's president of the American Action Forum and former director of the Congressional Budget Office. So, Douglas, thank you so much for being with us.
Sure.
Is it all about inflation? And I guess my question is, how can we have inflation like this and be so concerned about recession at the same time?
I think there are really two things going on here, David. One is we came into this year with a lot of excessive stimulus on both the fiscal and monetary fronts. Second half of 2021, the inflation was already picking up, and really nothing was done to reverse course. And so I think there was a fair amount of froth in a lot of these asset markets and pricing above fundamentals, and that's been corrected. Now we're looking at the fundamentals, and I think people are learning really two very important things. Number one, the scale of the problem that the Fed faces in trying to control inflation, the gap between real interest rates, the instrument they can actually use to control inflation, and the inflation rate is as large as it has been since the early 1970s. And that was a nearly decade-long struggle to get inflation under control. I'm not saying it'll be a decade long, but it's a big problem. The scale of the problem means a lot of financial tightening, shrinking portfolios, raising rates, and I think people are just coming to terms with that for the first time. And you see a lot of, I think, quite shocked investors out there realizing what's gone on. The second is that past the sort of near-term issues with the Fed tightening and controlling inflation, there doesn't appear to be any strategy for long-term growth that the administration can sell to people. They're looking out there and seeing, okay, we're going to slow down the economy. Best news is we avoid a recession, but we're not going to grow. And where's the growth, I think, is the second big issue that's plaguing the market. They need to see a strategy to really get some genuine growth when they're worried about the inflation and the potential for a recession down the line.
Doug, in your estimation, do you think the Fed can get inflation under control without triggering a recession? And by the way, do we have to have increased unemployment, substantially increased unemployment, to have that happen?
Well, the Fed is going to raise rates, shrink the portfolio, and that is going to be, other things being the same, bad news for the monthly data that we get, from Bloomberg. We're going to see monthly employment reports that show higher unemployment rates, slower job growth. We're going to see retail sales that are slower than they've been this past spring. We're going to see a housing market that has to cool down. That's a big transmission mechanism for a Fed tightening. And all of that means that we're going to get a slowing economy. The real question is, will it just slow or will it actually dip into negative territory? You can't rule out the Fed pulling off a soft landing, but you can look at the track record and recognize that in these circumstances, inflation above 4, unemployment below 5, the Fed's never historically pulled it off. So we're asking them to do something that is at odds with their historical record.
Doug, you talk about the economy slowing. How quickly will it slow? Because we see a lot of reports that particularly consumers' household balance sheets still have a lot of cash, and the consumer could keep spending for a good long time to come. Could he not?
Yeah, I think one of the real puzzles this spring has been the gloomy consumer sentiment numbers, which we see every month and are now at lows rivaled only by the 1980s, and the personal income and outlay numbers where, personal outlays household outlays have been very strong. There's cash on the balance sheets. There's enough income growth. It's not great to support that. And so this economy is not going to slow overnight. And I'm not really genuinely concerned about elevated inflation or elevated recession risks in 2022. I think the elevated recession risks are in the second half of 2023. The near term is the Fed leaning hard against an economy that is actually running quite hot.
Douglas, I think that one of the challenges we have is it's been a while since we've had a big downturn, and there are a lot of people, money managers and others, investors, who haven't really had to deal with it before. One of the things I wonder if is different this time in this downturn, which seems to be what we're heading for, is we have so much of the market in passive investing. What could that mean for handling the downturn?
I think one of the most important things the stock market does, from an economist's point of view, is price discovery. How do you identify promising new uses for assets when you're coming out of a downturn? How do you repurpose capital in the economy? The stock market sends those signals. The only way that happens is if someone's taking a risk, saying, hey, I think this is more valuable than everyone else. I'm going to buy it. And that's going to lean against what all the passive investors are doing. If no one's out there doing price discovery, no one's out there doing the risk-taking that leads to reallocating capital, the stock market's a less efficient entity. And so all of that passive investing, I think, runs that risk.
Douglas, as I say, we always ask economists why. Let me ask you another why. You said earlier that the markets are just figuring out the problem with inflation. Why were people surprised on Friday? Were you surprised?
I was not surprised. I don't know why people were surprised. There's, if you look at the producer price index, we'll get another edition of that tomorrow. That's been running in double digits for months. And so there's a lot of pressure on prices that comes from the pipeline. There was no reason to expect the CPI to simply drop off. And anyone who either believed that spin coming out of policymakers or somehow thought that was what was in the data, I think really was misreading the situation.
Okay, we can't let you go without asking about the Federal Reserve, which is meeting later this week. We're going to have a decision on Wednesday. Where are you on what the Fed should do, not just for this meeting, but for the one in July and in September?
I think they should stick to their plan. I mean, they've been talking an aggressive game, 50 basis points, 50 basis points, 50 basis points. Absolutely, they should do that. And they could continue to shrink the portfolio. We do not yet know how much financial conditions tighten as they do that. That's a wild card. And so do that and then take a look and if necessary, continue at 50 basis points. Do what you need to show a discernible decline in measured inflation.
We talked about likelihood, possibility of recession. What about stagflation? And how important are consumer and the market's expectations? And I guess what I'm really asking is, what happens if we lose faith in the Fed?
That is everything at the moment. That is why the Fed, I think, has talked a big game to try to convince consumers, investors that they can control this inflation and will. That is why they need to stick to their game plan and not appear to, again, make a mistake by misreading the situation as they did last year. And if you can control inflation expectations, you take that propagation mechanism that was such a problem in the 70s and early 80s and take it off the table. If people aren't expecting 5–6% inflation, they aren't asking for 5–6% raises, and you don't have the cost pressures in the economy that you otherwise would. That's a crucial part of Fed's success, convincing people and following through to make them take those expectations back down to where they were 3% or so at the beginning of the year.
Doug, thanks so much for being with us today. It's Douglas Holtz-Eakin of the American Action Forum.